Welcome to a random talk down Quant Street. This new series takes you behind the scenes of quant investing, breaking down complex ideas and asking the questions you've been afraid to ask. For example, active quant strategies promise to outperform benchmarks, but what makes them truly active? Today on a random talk down Quant Street, we're joined by Vania Sulman. She's portfolio manager at Robeco, to explore what's active about active quant. So let's get started. Hi Vania, welcome.
Hi Erica, good to be here.
So what exactly is the active part of active quant?
Yeah, so before I can explain active quant, let me take it back to what is not active, right? So let's start with passive strategy, passive indexing. So that is a strategy that essentially just tracks the benchmark. It's copying the benchmark essentially. And then we can take it one level higher, and that is what we normally call enhanced indexing. So that is still tracking the benchmark with a little bit of deviation here and there. And then we can take it even further, and that is what active quant is. So that is a strategy that is still benchmark aware,
right,
but deviating quite a bit from the benchmark in order to outperform the benchmark.
So presumably all of this depends on the client's needs and investment objectives, right?
Correct.
So how would you go about it? So I would understand in a fundamental equity environment, it's about, how you select your stocks with fundamental research. So in a quant environment, how do you achieve that activeness?
Yes. So first of all, how do we consistently outperform the benchmark? So with active quant, what we aim to achieve is to have a systematic exposure to proven factors. So I'm talking about value, quality, price momentum, analyst revisions, as well as the short-term stock selection signal. So we aim to have a systematic exposure to those factors. And while doing so, we are able to deviate from the benchmark. So how do we achieve that activeness? By taking larger positioning with respect to region, sectors, countries, and even individual names. By doing that, we are actually making sure that we are positioning the portfolio in order to capture the alpha that comes from the model that we just talked about.
So the alpha being that outperformance better than the benchmark. Can you guarantee that you will achieve that degree of activeness that you've set out to do?
Yes. So with respect to active quant, we aim to have a tracking error of around 3%.
So explain
what is
that.
Tracking error? So tracking error is essentially a degree of deviation from the benchmark. It's essentially the deviation of the performance of the portfolio with respect to the benchmark. A higher tracking error meaning that the performance deviates more relative to the benchmark. So we talk about enhanced indexing a little bit in the beginning. So enhanced indexing typically aims for a tracking error of 1%. Active quant is around 3 times as high as that, so around 3%. But we don't make it a hard objective. So what we aim to do is to have this 3% tracking error in the long term on average. So at any given moment, it could be a bit higher, it could be a bit lower, but ultimately in the long term, we want to achieve around 3% tracking error.
So you used the phrase taking larger positions. I assume that it also could mean smaller positions, overweighting or underweighting relative to the benchmark. So would that be in terms of sectors or also individual names?
Yes, it's all of the above. So with respect to our developed market strategy, for instance, we take deviations with respect to region and sectors. And then in emerging market, we take deviation with respect to countries. But also in both, we also take deviation with respect to individual names. And you might think, okay, that can be risky, right? It can be a bit undiversified. Well, with active quant strategy, we start with even broader universe. So actually even broader than the benchmark itself.
So thousands?
So thousands of stocks. So when we have a lot of stocks to choose from, the model and the portfolio construction can work better and more effectively in choosing the right stocks. Right? So we have a larger universe to begin with. The model comes into play, portfolio construction comes into play, picking the right stocks while at the same time trying to adhere to all the constraints that we set. And in order to do that, we need the portfolio construction algorithm. So in the end, what we have is still a healthily diversified portfolio. So on average, in the long term, an active quant portfolio will have around 250 names in the portfolio.
That's a large portfolio.
That is still a large and diversified portfolio.
The way you've described it, where it sounds as though there's a degree of intervention, and I suspect it's not all just machine-based or algorithm-based. Is there human involvement here?
That's correct. So largely it's dictated by the model and the portfolio construction. However, sometimes there can be some exceptions, such as geopolitical tensions or companies that are under fire due to controversies, etc. So model can be fast enough, but maybe not fast enough in order to capture these dynamics. And that is when human oversight comes in to also make sure that we are correctly positioned on those names.
So in brief, what does that look like when the human intervenes and steps in?
Yes. So when a portfolio manager rebalances the portfolio, the starting point is what the portfolio construction algorithm proposes as an optimal portfolio, right? So this is a portfolio that aims for high exposure to the factors while adhering to all the constraints. But it could be that any given moment there can be maybe controversy or bad news surrounding a company, or maybe even corporate action going on. So it may be that the model does not pick it up quickly enough. And that is when a portfolio manager can still step in and maybe change a little bit of the positioning, not too much. In the end, it's still a quant portfolio, a little bit in order to make sure that we are correctly positioned in those names.
Makes sense, Vania. Thank you.
Thank you, Erica.
And that's all for today's episode. Up next, Vania will be back to discuss how Robeco captures quant alpha. We'll dig into the strategies, tools, and techniques that make it all work. Don't miss it, and remember to share the series with anyone curious about quant investing.